The Iran war just triggered something most people have no idea even exists, a forced gold liquidation on a scale we've never seen before. Central banks that spent years carefully stacking gold are now being pushed to sell it by the ton. And it's not a strategic choice, it's survival. Turkey alone liquidated 58 tons in just 2 weeks. Rumors swirl that Gulf states are quietly selling as well, while Russia is actively limiting exports. If you own gold, gold miners, or any metals, this is either a massive risk that could wipe you out or the single biggest buying opportunity in decades. By the end of this video, you'll understand exactly how the Iran war triggered margin calls for entire countries, which nations might be forced to sell next, and a 3-phase playbook for positioning yourself before this reset is over. My name is Felix Pin. I'm a former investment banker. That behind me is Winston, my golden retriever, who's actually the real expert around here. I'm also the founder of the GOAT Academy, where my retired Wall Street mentors, including market makers from the metal exchanges, teach ordinary investors the same institutional strategies they used on Wall Street. Over the last 6 years, we've trained more than 20,000 people. Our mission is simple: give regular investors access to the knowledge and tools usually reserved for the top bankers. Today, I'm exposing how a war in the Middle East sparked the largest forced gold liquidation in modern history, and Wall Street saw it coming. If you've been watching gold drop while the Middle East burns and wondering why, type confused in the comments, because you're not alone. Most of us are in the same boat. Before I dive into the numbers and the mechanism, if you want to actually learn how Wall Street selects stocks and metals during chaos like this, not the Reddit hype, but the real institutional playbook, I'm offering that for free in a live training happening right now. You can sign up at felixfriends.org/training. It's completely free. And it's your chance to see what the big players are actually doing during moments like these. Let's back up for a moment. Gold had an incredible run in 2024 and 2025. Central banks were buying aggressively. China, India, Turkey, Poland, all stacking, pushing gold toward $5,000 to almost $6,000 an ounce. Gold enthusiasts were celebrating, predicting $6,000 or even $7,000, and then it collapsed. By March, gold was down over $1,000, a 15% drop in a matter of months. The financial media called it profit-taking or a technical correction, basically shrugging and saying, we have no idea. But we can see who at least some of the sellers were. Using geopolitical dashboards, you can track central bank gold flows, who's buying, who's selling, and who might be preparing to sell next. These tools are inexpensive, about $6 a week, and you can cancel anytime. When you map it out, the picture is clear. Turkey and parts of the Middle East are the main players right now. Turkey's central bank swapped about 60 tons of gold in just 2 weeks. Think that's small? That's bigger than the total outflows from every gold ETF in the world combined. ETFs saw about 43 tons leave. Turkey, about 60 tons. And this is a country that spent a decade buying gold to reduce its dependence on the US dollar. The Iran war forced them to do a complete 180. They now desperately need dollars. Why do countries like Turkey or Gulf states have to sell? It's not optional. Turkey imports 90% of its oil and 98% of its gas. Its domestic energy production is almost zero. When oil prices jump from $70 to over $100 due to the war, their import bills exploded. Every $10 increase in oil costs Turkey an extra $4.5 billion per year. With oil up $50, do the math. That's a massive drain. They had 3 options. Let the currency crash, which is political suicide, burn through dwindling US dollar reserves, or sell gold to raise dollars. They chose the last option. The mechanics are complex but straightforward. Turkey holds roughly $30 billion of gold at the Bank of England. They entered a gold for foreign exchange swap, essentially pawning gold to receive dollars, with the right to buy it back later. Imagine walking into a pawn shop with your grandmother's gold jewelry. That's what they did, on a massive scale. Selling that much gold naturally pushes prices down. Turkey's situation is serious, but the Gulf states face an even bigger challenge. To understand why, we need to talk about currency pegs. Many Gulf countries, including Saudi Arabia, Qatar, and the UAE, link their currency to the US dollar. Normally, they sell oil, collect dollars, and maintain a stable peg. But the Iran war disrupted the oil flow, effectively shutting off the faucet of dollars. Meanwhile, expenses are rising: food imports, machinery, military spending, all paid in dollars. Their currency bathtub is draining. If the reserves empty, their currencies crash, inflation spikes, and economic faith collapses. Central banks have to act to prevent a margin call that could topple the economy. The choices are the same as Turkey's: break the peg, burn through reserves, or sell gold. Breaking the peg is political suicide. Reserves are already dwindling. That leaves selling gold as the only viable option. This is why the rumors of Gulf countries selling gold in London matter. They're likely converting gold to dollars to maintain economic stability. While we don't have confirmed numbers, early reports suggest net London outflows around 45 tons in the first 2 months of the year. Sovereign wealth funds, like the PIFF in Saudi Arabia or the QIA in Qatar, don't have to report gold holdings to the IMF, so these sales happen quietly. The mechanism is clear. The war disrupts oil revenue, expenses rise, and countries are forced to liquidate gold to survive. But does this mean the gold bull market is over? Not at all. Russia, one of the largest gold producers, is restricting exports starting April 2026. This reduces the global supply available, even as some countries are forced to sell. And while short-term volatility hits, the long-term fundamentals for gold remain intact. Now, let's dive deeper into what this forced selling really means for the gold market. Think about it this way. Countries are being margin called, just like a trader in a brokerage account, except we're talking tens of tons of gold instead of a few $1,000s. Turkey's gold swap is massive, but the Gulf states could be even more pressured. Saudi Arabia, Qatar, Kuwait, the UAE, they all peg their currencies to the US dollar, and the Iran war has essentially turned off the flow of dollars from oil sales. At the same time, expenses are skyrocketing. Food, machinery, military spending all need dollars. Their economic bathtub of dollar reserves is draining fast. If they do nothing, the currencies could collapse, inflation could spiral, and the public would lose faith in the system. That's why selling gold is not a choice. It's a survival tactic. It's also important to understand how much this affects the overall gold market. When Turkey swapped 60 tons of gold in 2 weeks, it surpassed all the gold ETF outflows worldwide combined. That's not a small ripple, it's a tsunami. And while Turkey's actions are highly visible, Gulf states are moving quietly, selling gold through London accounts and swaps. The reason it's quiet is simple. If markets know a country is selling, the price drops even more. So they sell in the shadows to minimize impact, but it still depresses the market. Meanwhile, Russia's taking a completely different approach. They're restricting gold exports starting in April 2026, effectively removing a huge chunk of gold from international circulation. Russia was already kicked out of the London Bullion Market Association in 2022, and G7 countries banned Russian gold imports. So now Russia is building its own parallel financial system and gold market. For Russian gold holders, the incentive is clear. Sell now or risk being locked into an asset that cannot be moved freely. This will inject more gold into the market, causing short-term downward pressure, but it also reduces the long-term supply available internationally. So we're seeing three main forces pushing gold down simultaneously. First, energy importing countries like Turkey, India, and some EU states are burning through their US dollar reserves due to the oil shock. They are selling gold to raise dollars. Second, the US dollar pegged countries in the Gulf are likely selling as well because oil revenue has fallen, but spending obligations remain. Third, war funding countries, including Russia and Poland, are monetizing gold to finance military operations. In Poland, for example, the government is considering monetizing 550 tons of gold to raise around $13 billion for defense spending. Russia sold $30 billion worth of gold last year. And even China, typically the largest state buyer, paused purchases in late 2025. The central banks that once supported the gold market have temporarily stepped back. Despite all this, the long-term fundamentals haven't changed. The war reduces the supply of new dollars in the Middle East while increasing the need for dollars to cover costs. At the same time, interest rates in the US rise, making Treasury securities more attractive than gold in the short term. That's a normal market reaction. Money flows to the assets offering the highest return or perceived safety. But if we zoom out, the broader story for gold remains intact. The US government is running a massive deficit, likely to print more money and artificially suppress interest rates in the future. Dollar devaluation is almost inevitable over the long term. Russia restricting exports and building its own financial system removes gold from international circulation and reduces dollar demand further. So what does this all mean for investors? Short-term volatility is high. Prices may fluctuate sharply as these forced liquidations happen, and the market may look scary to someone used to steady upward trends. But if your focus is long-term, this creates an opportunity. You have an unusual window where gold prices may be temporarily lower than the underlying fundamentals would suggest. The market is offering a chance to buy during distress, a rare scenario in modern financial history. Tracking these moves isn't as complicated as it sounds. At the institutional level, traders follow the flow of smart money using a combination of market data, vault inventories, ETF flows, and geopolitical intelligence. You don't need insider access to spot trends. You need to understand the rules of the game. For example, when net ETF outflows spike, but central banks continue to hold or buy gold, it signals that temporary market fear is creating a buying opportunity. Conversely, when central banks start selling aggressively, it indicates that macroeconomic pressures are forcing a pause in the bull run. There are also valuable data points that can guide decisions. Gold and silver premiums, vault inventories, swap agreements, and speculative positions in futures markets. None of these alone gives you the complete picture, but together they allow investors to see the larger framework. This is exactly what Wall Street does. They don't guess based on headlines. They follow the structural signals and apply rules honed over decades. Understanding this framework puts you in a position to make informed decisions, rather than reacting to fear or hype. Even beyond these technical indicators, consider the geopolitical factors. The Iran war has disrupted oil flows, pushed energy importing nations to sell gold, and pressured Gulf states' currency pegs. Russia is restricting exports and creating parallel financial systems. Wars and sanctions are reshaping supply chains and liquidity flows. Gold's price may seem volatile in the short term, But the underlying scarcity of supply, combined with long-term inflation and currency devaluation trends, means the asset remains fundamentally strong. The story of forced liquidation also highlights the difference between strategic buying and survival selling. Countries like Turkey and Gulf states didn't choose to sell because they wanted to make a profit. They were forced by macroeconomic realities. Understanding the motivations behind these moves is key to interpreting market signals. Institutional investors watch these pressures closely to anticipate not just price changes, but the timing of future reversals and opportunities. In short, the gold market is caught in a perfect storm. Short-term selling pressure from forced liquidations, disruptions in supply from export restrictions, and long-term demand driven by currency devaluation and global uncertainty. For someone who understands the dynamics, this is not a time to panic. It's a time to watch carefully, understand the forces at play, and position accordingly. Now, let's get into how this forced liquidation plays out in practice and what investors need to watch. One of the most important things to understand is timing. These margin calls and emergency sales don't happen all at once. They roll through the system like waves. First, countries with urgent dollar needs, like Turkey, sell aggressively. Then, the Gulf states under US dollar pegs start adjusting as their reserves decline. Next, war-funding nations like Russia, Poland, and potentially others move their gold into liquidity to cover military expenses. Each of these waves adds downward pressure on gold prices, temporarily creating volatility. But that volatility isn't chaos, it's predictable if you understand the mechanics behind it. Take Turkey, for example. By converting roughly 10% of its total gold reserves into US dollars through swaps in London, the country caused a market impact larger than all global ETF outflows combined. That's how small actions in the institutional world can create massive ripples. And the Gulf states, their peg to the dollar forces them to act to stabilize their currencies. They cannot allow their dollar-linked currencies to devalue, or they risk political unrest and economic collapse. Selling gold becomes a defensive maneuver rather than a speculative one. This is why central banks often sell in private channels or through swap agreements. They are trying to meet obligations without creating panic in the market. Meanwhile, Russia's restrictions on gold exports are another factor that changes the market landscape. By limiting exports, they are taking supply offline at the international level. This initially increases volatility as holders of Russian gold rush to liquidate before the April 2026 cutoff. But over time, it reduces the global supply of gold available for transactions, which is bullish in the long run. History shows us similar patterns. When major producers restrict supply, markets experience short-term price dips, followed by long-term upward pressure. The key is knowing when the short-term panic is over and the long-term scarcity begins to dominate. Another factor driving these moves is the US dollar itself. Interest rates in the US have risen, which temporarily attracts capital into government securities and away from gold. Higher rates make US treasuries more appealing, but this is cyclical. Once the government decides to print more money to cover its deficits or suppresses rates artificially to manage debt, the long-term story shifts back to gold and other hard assets. Understanding this interplay between fiscal policy, interest rates, and global gold demand is crucial for making informed decisions. Investors who panic during short-term volatility miss the broader trend. Now, let's connect this to practical investing. Wall Street doesn't act on fear, they act on structure and signals. The same way you track a company's earnings or cash flow, institutional investors track flows of gold, ETFs, and sovereign reserves. They watch vault inventory, swap agreements, and net purchases to identify buying opportunities. When central banks are temporarily selling, it is often a signal for long-term buyers that prices are temporarily depressed. Following these institutional signals is far more reliable than reacting to headlines. Consider the geopolitical aspect. The Iran war has disrupted the flow of dollars from oil exports. Energy importing countries are selling gold to cover costs. Gulf states under dollar pegs are stabilizing their currencies, and war-funding nations are monetizing gold. Each of these forces is acting simultaneously, creating both risk and opportunity. For example, if you only look at price charts, you might see gold falling and panic. But if you understand the mechanics, forced sales versus strategic buying, you can interpret this drop as a temporary dislocation rather than a collapse in fundamentals. One interesting point is how rumors and opaque reporting affect the market. We don't always have direct confirmation of how much gold is being sold by sovereign funds or central banks. Saudi Arabia, Qatar, and others don't report all their holdings to the IMF, and many sales happen through London accounts, swaps, or ETFs. This creates an environment of uncertainty that some investors interpret as risk, while savvy institutional players see it as an informational edge. They use indicators like vault inventory, premium pricing, and swap activity to infer what's happening behind the scenes. This is exactly what separates professional traders from retail investors. Another important layer is comparing short-term market movements with long-term trends. Even with these forced liquidations, the fundamental drivers of gold remain intact. Dollar devaluation, inflation concerns, geopolitical instability, and scarcity of supply continue to support the long-term value of gold. Short-term volatility creates opportunities, but understanding the timing and the nature of these pressures is essential. Buying during panic is counterintuitive for many, but historically it is where the most significant gains occur. Also, don't forget the institutional lesson. Follow the money. Wall Street and central banks don't act randomly. They move based on rules, risk calculations, and structural pressures. By understanding these rules, like how margin calls, swaps, and peg mechanisms function, you can anticipate movements rather than react to them. For example, if you know that Gulf states are under pressure to maintain their dollar pegs and that oil revenue is constrained, you can infer that they might sell gold quietly. That knowledge allows you to position ahead of the crowd. Finally, think about the ripple effects. Forced selling in gold can impact other metals and commodities. Silver often mirrors gold movements, and ETFs in other metals can see correlated outflows. Understanding the interplay between gold, dollar, liquidity, and geopolitical events allows investors to see the larger system at work. This isn't just about owning gold, it's about understanding how macroeconomic forces shape asset prices globally. By now, you should start to see the pattern. The Iran war triggered an oil shock that drained dollar reserves, forced Turkey and potentially Gulf states to sell gold, pushed Russia to restrict exports, and created volatility in global markets. Short-term movements might feel chaotic, but they follow predictable institutional logic. Understanding this logic gives investors an edge that the average retail trader doesn't have.